Hey, everybody. This is Richard again with Trade Oracle Group. And this afternoon, we're going to talk about two option strategies that you use in rising volatility markets. So there's two areas where volatility is kind of something to be concerned with. One is when it's exceptionally high, there's certain things you should absolutely not do. And when things are really low in volatility, there's some things you should absolutely not do. In the middle, it's important to pay attention to what the general direction is in volatility in options. And that's because Vega, also called Vega, has a very distinct impact on the pricing of options. And sometimes the volatility, the Vega at near-term contracts has a different impact on the pricing of that options contract than the next term out and the next term out. So it may be that in the short term, you're getting these spikes in volatility. So pricing is extra high over the short term, but generally speaking, things like gold, that happens too. Gold is bouncing around like this, the vol is high, short-term contracts add an extra few cents for that. But then the stuff for 6 months away is not as high, and it's all this volatility is still within a band that has some trend. And so the longer term volatility, that's absorbed into the time value of that option, which is theta. And so time value and volatility and underlying value or intrinsic value are kind of the three most impactful values on options. And so today we're going to talk about changing volatility. How does that make a difference? Well, I'll start off by saying that we recently had a drop in volatility and it dropped to the lows. And I shared with people that were members of Trade Oracle Group that if you're in this space, this is a time where normally, if you're a very conservative trader, this is an opportunity where if you're buying longer term contracts, and by longer term, I mean 3+ months. So 3 to 6 months out, typically, sometimes as much as 9 months out. If you're buying those contracts, this is a time to buy those. If you're long only, you're buying calls, you think something over the next 6 months is really going to rise up or something's really going to fall apart, it's a time to buy those calls or buy those puts. And that's because you're not paying as much of all the different components that you add into the bill. When you buy an option contract, there's an expense, there's an intrinsic value, a theta, a vega, and a handful of other Greek values that we'll talk about at other times. Right now, focusing on volatility, it's one of the core components or one of the core costs in buying an options contract. Let's look at the other side of that. It's also a core component in selling a contract. So if volatility is high, and when volatility is high, there's a premium added and it's higher and higher and higher. As that volatility goes higher, common sense would tell you, you want to be a seller of options, whether they're selling calls or selling puts or selling spreads. You want to be a seller typically when vol is high. You want to be a buyer when vol is low, right? So what do you do when it's kind of in the middle, but it's trending in one direction or the other? Well, I'm going to pull up a Word document and we're going to start writing notes. And this is just so that you have some format and structure and you can visibly see it. And perhaps if you have questions, you can ask them in the chat room or what have you. And we'll go from there. You can send it to us on our Facebook page. You can join us in our Discord room and ask those questions either in the chat room or wherever you can get a hold of folks, and somebody will help answer that question for you. So we really, traders get better through education, right? We learn by hearing and by seeing and by doing. And so whether you're listening now, when you get into the chat room and you see other people doing it real time, it really helps. And then when you do it yourself, it makes it impactful and you will remember it interminably. So let's go to a sheet so that you can see it, not just hear it from me, but you can actually see it. So I'm going to share that screen and let's see, I'm going to share this Word document and we'll go from there. So this is, again, two option strategies for increasing volatility markets. So right now, and let me see if I can draw a little picture of this. I don't know if I have the, there we go. And I will make it blue. So when we have increasing vol, so I'm going to use gold as an example because I trade a lot of gold. So you had volatility go way up. And how do we look at vol? It can be the VIX, the CBOE VIX index. It can be, you have an S&P volatility index. You have volatility on many indexes. The CBOE volatility is probably the most often. seen one. And so volatility oftentimes happens like this. And so you'll have in the low ranges, I'll go back to writing this in, and we'll stick it in a text box. So we go from an area that oftentimes is somewhere in the 10 to 12 range of volatility, and upwards of, I'll copy this over. And then the upper ranges are typically, and I'll make sure that we mention kind of the exceptions. Typically, we're talking about 24 to 30 in the VIX, but every once in a while it smokes past that and it goes to 40, 50, 60, and it just gets really crazy. And it's actually done that a few times in the past year, which is really strange, and it scares people to death and what have you. But the bottom line is volatility can be 3 or 4 or 5 times normal, but an options contract, if it expires in 10 days, it expires in 10 days. Where the volatility is high or the volatility is low. So if there's a bunch of extra pricing in that options contract, so normally the intrinsic value is the value that's actually in it. So if its stock is at $50 and you are buying a call option at 45, then it's already $5 in the money, ITM in the money. So if you're buying one that expires in 10 days, you're going to pay at least $5 because it already has that intrinsic value built in, because you're buying the right to purchase it at 45 and it's already at 50. And then there's the time value, there's the volatility, and so on and so forth. So you may pay 50, you may pay the equivalent of 52. So instead of paying $5 for that option, you may pay $6, for example, for that option. And the bottom line is at the end of 10 days, wherever it settles, the difference between 45, wherever it is the value. So time decay, volatility, all erode to nothing. And so that timeline actually goes like this. And in the last week or so, it drops off precipitously, and those values go to zero. And all that you're left with is that intrinsic value. So when things are in the middle, which is kind of where we're at now, how do you trade that? Well, if you can see that there's this kind of pattern, and I'm going to circle a couple of these. If you can see that you are in a place like you are right now, like this, and it looks like it's heading up, then you know that volatility is going to increase, or you feel highly likely volatility is going to increase, that it also means that the premium is going to increase. So what does that mean? If the premium is going to increase and you're selling premium and it continues to go up and up, the stock may actually drop, but the options price may not change very much because the volatility is going up. And because of that risk, there's added premium in the options contract. So not only is it important when it's really down low volatility that you're always buying, and when volatility is really high up, you're always selling. You also want to pay attention to direction. So this is why vol is important. I'm going to make some notes here and stretch this out just so we're all on the same page. So why is vol important? It's important because it determines the likelihood of an options contract price going up or down. Move this up in the near term. At the end of the term, it doesn't really matter, right? At the end of the day, it doesn't really matter, but it can be going up and up and up and up, and the price isn't really going up much, but volatility is going up, and so you're losing money, even though the price isn't really moving. Well, you can actually get called out on margin. You can have to put up more margin. You can have all sorts of things go on if you're in the wrong direction of volatility. So it's important to pay attention. That doesn't happen very often, but it can absolutely happen. But the other thing is, if you think of volatility as a hedge, right? So the second thing is volatility acts as a hedge. And there's a couple of different kinds of hedges. One is the hedge is you can have a hedge against the wrong direction. You can also have a hedge against poor pricing or timing. So you got in thinking it's the top and it keeps going up a little higher, where if the volatility is high, you got paid a little extra for that error. So even if you're not right at the top, but volatility is high, when you sell it, there's enough premium there where it may keep going against you, like we were saying, where normally that could work against you. If you're a seller, it can work for you. If you're a buyer, it can work for you. And so if it's dropping down, but the volatility is going up, you may still be okay, and you can get out of that trade. You can see it going against you, but volatility in the markets is going crazy. It's a chance for you to get out of that trade even, or sometimes even make a little bit of money, because you were going into a place of increasing volatility. So if you bought it and volatility was increasing, even if the price doesn't go in your direction, you can sometimes sell it or break even. It gives you a hedge against not being at the right price or the right direction, or buying or selling at the right time. So volatility can certainly act like a hedge. So when do we change our approach? Question number 2 is really, when do we change our approach to buying or selling based on volatility? So if we kind of scroll down again and we look at this graphic, we say, if it's in the middle here, how do I know whether I should be buying or selling a contract? It's a great question. I'm going to put a couple of boxes here just so you can kind of make general rules, and then you'll see where it melds. And there will be a little bit of art and science in the middle. So part of it is we're going to cover what we can as far as the science goes, but it's important to, as you do it time and time again, you'll develop kind of an artistic feel for it, and you'll have an idea. And you've heard me say, if you've watched my videos or been on any of our other interactions on Discord or our chat room or any of those sorts of things, is that it's not so much the data as it is the delta. And delta is the rate of change, right? So it's not so much what the price is right now, but where's the price come from and where's the price going is really what we care about. If you put $1 million into an account and the price doesn't change, you didn't lose any money, but you didn't make any money. As traders, we only make money. There's only one exception to this rule. We only make money when things move. They either go up or they go down. The exception to that rule is selling call option contracts. Sometimes selling put option contracts. And that's because if you sell a contract that expires in 10 days or 20 days, and the stock is at $50, and you sell something at $50, there's a value in that contract, time value, and volatility, vega and theta, and a couple of the other Greeks are built in. So even though it's at 50, you're not buying that option for zero, you're paying whatever it is, 25 cents. That 25 cents will erode until it goes to zero. So the only time you ever make money with stocks or bonds or futures or crypto or Forex not moving is by selling premium, whether it's a call option or a put option, is selling that premium. So there is a slight mathematical advantage to being a seller, a slight mathematical advantage. You can make tens of millions of dollars with a slight mathematical advantage. So one of the lessons to take away today is, where and when possible, it's better to be a seller of options than to be a buyer of options. If you're a buyer, you're paying for the theta and the vega, and every day that it runs, it's slowly dripping. It's like that faucet or the leak in the bucket is slowly draining out the value of that contract. So it needs to move faster where you want it to go than the measure that it's dripping out of the bottom of your bucket. So how do we change the price? I'm going to add in a text box here. Oh, did I not do this correct? Draw a text box. There we go. Okay, so here's one text box. Put another one right here in the middle. And then we're going to put another one right down here at the bottom. And we're going to talk about each one of these. So when volatility is high, when it's up above, I like 26. When it's above 26, 27, 29, I'm looking for options that I can sell premium on. That means that I'm getting a little bit of extra vig, a little bit of extra spread, a little bit of extra juice, whatever you want to call it, by selling that contract. So it's the underlying value saying it's already got $3 or it has whatever, but that extra value gives me more hedge, it gives me more risk, and it gives me more profit. So if normally things are flat and I would sell an option on a stock at $50 that expired for days and it cost $1, I may sell it for $1.50 partly because of the theta, the time value. It takes 30 days for it to expire, but I may get another 50 cents in value or whatever from the volatility. And that volatility value increases that premium. And that's all potential profit for me strictly because of the volatility in the market. So there's two things that can happen from that, right? This is high vol equals increased be able to get it all in that one thing. So let's see if we can reduce the size of it. So high vol equals increased, stretch it out this way. There we go. Equals increased premium, right? So increased premium, if you're a buyer of insurance or and really an options contract, that's what an options contract is for many people. Options really started out as a hedge against the underlying markets. If you are a farmer and you grow corn, you sell contracts against it at the price you'd like to sell, so that if it ends up being priced below it, you've sold a little bit of a hedge. If it ends up going higher, you've brought in a little bit of premium, but you're putting a cap on how much you make because of that premium. But the higher the vol, and by saying vol, I mean volatility, right? The higher the volatility, the more increased the premium is. And so here, if the premium is increased, do you want to be the insurance company or the individual or company buying insurance? You want to be the seller, right? So high volatility equals increased premium, which equals a seller. You want to be a seller of options contracts when that happens. And volatility is not direction intensive necessarily. So it may be that markets are moving down quickly and you want to be a seller of call options, or excuse me, a seller of put options as it goes back the other way. It may be moving up quickly and it doesn't really matter, right? Volatility is kind of its own net issue, not necessarily directionally linked. So when volatility is going up, you typically want to be a seller of contracts. So let's go to the other side here, and I'm just going to copy this to make it quick. So if you have low volatility, what do you expect? It's the opposite. It's decreased, right? It's decreased premium. And do you want to be a buyer or a seller? This changes now, right? Now you want to be a buyer. So let's talk about a couple of instances, and then we're going to go to the middle because that's where the art and stuff comes in. So if markets have been going way up and premiums are going way up, and you think they're going to continue going up, if you think they're going to be going up, you want to be selling. You want to be a seller because the volatility is high. So you've established number one, I want to be a seller. But the market you think is going to continue going up. So one reason there's high volatility is there are all sorts of new money coming in. Technologies are doing really well. Interest rates are low. Whatever the case may be, things are going up. And you want to be a seller because that volatility adds extra premium. But you want to be a seller of puts, right? Because if you sell a call option gives the person the right to call out your stock at whatever price you wrote a contract. You think of it as real estate and you go, wow, real estate's going crazy. I'm going to sell an option to this guy to buy this acre of land for $100,000. But if the price of the land was $50,000 a year ago and everyone else's land is going up, 20% a year, there's a likelihood that by the time he exercises that contract in 90 days, you could have sold it for 110, 120, right? So part of it is the volatility, but the other is if you're selling in the direction of where it's going and you're selling a call, you're more likely to get called out, number one, and lose value because you sold something for 110 that really was, you could have sold for 120. But you have the hedge of the premium where you may have sold the contract, that option for $5, where normally a year ago, you might have only been able to sell it for $3. So you sell it at $110. It's priced at 100 now. You sell an option to buy it at 110 and you sell it for $3. It's actually, you're not losing money until it's at 113, right? Because there's the strike price, whatever that option contract is, plus the cost of that contract is what you have brought in. So you don't have to sell it. Anything below 110 is profit for you. Anything really below what you sold and brought in as premium also is profit. So if it goes to 112 and you sold the contract for $3 at 110, you're actually still in the money $1. That's the power of selling contracts. The same thing goes to the other side, right? If the market, and well, let's finish with this. So if the market is going down and you can sell that 110, but because it's going down, you're probably not going to sell that 110 contract for $3. You may only sell it for $2 because other people in the market are seeing the market going away or being flat. So you're going to make money $2 because of the volatility in the market, but you're not going to make that extra dollar because of the trend in the market, right? So you may only sell it for $2, but it's a higher value, higher likelihood trade that you're going to make money on it because the market's going in the other direction, right? So that depends on, that's why for beginning traders, you typically want to trade where you're selling in high volatility markets in things that are trending in the opposite direction, or it's reached a resistance level and it's going to go in the opposite direction. That's probably almost better, because if it comes to a height and it's had 3 or 4 tops at that level and you can sell it, then it's up high. So you're getting that time value, the volatility value, and the potential risk of it going through that. And you'll take in a little extra premium for that. And we'll talk about each of the subsets of that at another time. But right now, it's kind of this is meant to be a quick start on a couple of strategies that you can use. So we're going to build into that. But that's the strategy that we're talking about. If premium is high because volatility is high. Now let's look at the other side. If volatility is low, stocks they went way up, then they're trending down, volatility drop, and now there's a lot of things that are slowly rounding and they're getting ready to turn in the other direction. It looks like, the market is flattened out, they're at key support levels and they're going to go up in the other direction. Then what do you want to do? You want to be long. You want to be long and strong, right? You want to own that underlying, but you can own more of it by owning an option contract. So if it's whatever it is, $50 a share, you can probably buy an option contract for $5 per share. And so you can leverage your dollars through that option contract. So normally, if we think that something's come to the bottom and the volatility is low, right? So it's not just the prices come down, because prices can come down and volatility is high. Why? Because volatility is going up and it's driven that stock down that might have otherwise been strong or medium weighted in its value, but the markets or the volatility is going up and people are scared and they're selling off that sector and it drops. What we're talking about is when the stock is down, the futures contract is down, and the volatility index is down. So people are not expecting as much. They think things are flattening out. They don't expect a lot, but we have a secret sauce. We have the ability to recognize patterns, which a lot of fundamental investors don't, because we teach pattern recognition. But more importantly, we have flow. And when we look on flow and we see that flow is predicting on multiple timeframes, remember, we like to see multiple moons in alignment, MIAs. We also like to see what we call time stacking, right? We like to see 60-minute, 240-minute, daily. We like to see all of them projecting, this thing is going to shoot up. It's going to really rock and roll over the next 3 days, the next 2 weeks, the next several months. And if that's happening, then all of the pressure in the market, short-term, medium-term, long-term, is all going to drive that symbol upward. Well, if we can see that, and it really is spiking, and a lot of times you'll see on flow that, that angle of attack is steep, and it's steep on the short term, it's steeper in the medium term, it's steeper on the longer term. That is a great opportunity when the price is at the bottom and the volatility is at the bottom. That means you're getting that option contract at a discount. You're getting it as cheap as you can get it. So that's the time to take a little bit of a different strategy. That's when you want to become a buyer of an option contract versus a seller of a contract. And so what we do to make it simpler is then we break it into two different sides underneath that. So when we change our approach on buying or selling on volatility, let's walk this forward. Selling in high vol and buying in low volatility. And so this means buying an option contract, selling an option contract. Doesn't matter whether it's a call or a put. It's because volatility is independent of that, right? But when it's in the middle, we change when direction is clear. Is direction always clear? No, it's very rarely clear. So how do you say, well, you could just change when direction is clear? Well, you change when you have a number of things looking like it's clear, right? And that starts with flow. That starts with looking at the charts and saying, look, it looks like all this stuff is getting ready to really take off. Can it sit and drag along for a while, for a day or two or three or five, and then rip? Absolutely. Does that ever happen? All the time, every day, right? Happens all the time. And we have a saying with flow. It's oftentimes early, but it's rarely wrong, right? So sometimes you go, well, this is going to take off tomorrow, and then it doesn't happen for 3 or 4 days. That happens all the time. So what does that mean? When you buy an options contract, you don't want to say, well, this is going to happen. This is probably going to happen by Friday. So I'm going to buy this option contract that expires in 7 days. Never do that. Always go one strike out. If you think it's going to happen in the next week, buy something that expires in 2 or 3 weeks, even better. If you think it's going to happen sometime in the next month, buy an option contract that doesn't expire for 2 months. If you're looking longer term, give it an extra 2 or 3 months. If you think it's going to happen, it's January, and you think it's going to happen in March, buy June. Pay for that extra, especially because what you're buying is cheaper when volatility is lower. So what happens if it just goes and it doesn't go much, doesn't go much, doesn't go much, but volatility in the market increases? You can actually still get paid. You may still actually make a lot of money, even though it doesn't go up a lot, because the rest of the market is increasing. And the market may go crazy and yours just kind of dribbles along, but because, and it may pop a month later, it may pop after your option contract expires. You may buy something that expires in 3 weeks and it actually doesn't get its big move for 4 weeks. Your hedge is that you buy in low volatility, and as the volatility starts fanning, as it starts increasing, bouncing around, when you have that peak, you can actually sell it, make money, even though you weren't exactly correct. That's one of the beautiful things about options trading, is you don't need to be exactly correct to still make money when you have these other factors working for you. And volatility may be the single biggest advantage that you can have in buying or selling an options contract. So let's go to the middle side. When you know that there is direction changing, and sometimes it's in the middle, but there's a pattern in volatility and it's dropping down, how do you know that the volatility is going to go up like this? Just because it's in the middle, it looks like it's an inverted head and shoulders to start with, and you see that that comes true the way that I drew it. But we don't always know that. It could have come down and dragged along for a while. How do I know whether it's going to drag along and actually the volatility is going to lower over the next few days or few weeks or what have you? Well, that's where flow comes in. Use flow to see those markets where it looks like that stock or that futures or that Forex is going to move. That's one. The other is because this is not a chart of where something's going to move. This is a chart of volatility, right? But if you can see a number of things moving, then there's a real likelihood that volatility is going to increase. And it's also important to, if you can, to look at volatility that's relative. So you don't want to look at volatility on the S&P 500 if you're trading a European bond, right? They're not related. So the volatility needs to be related to the market that you're trading. So let's put that down under one of these. Make sure the vol index being followed highly correlated. It actually doesn't need to be the exact same, but it needs to be highly correlated with the market or the symbol that you're trading. That's one. Move that down a little bit. We'll move this all down a little bit so we have more room to write, okay? So if it's in the middle, it's not that it's in the middle. You could technically be a buyer or you could technically be a seller. If it's in the middle, which way do you think that I would want to invest? Would I want to be a buyer or a seller if it's in the middle? Well, remember what we said initially is that options contracts by nature have an extra hedge built into them, an extra cost that's added to it. When you buy this, there's an extra tax, and that tax is vega. That tax is volatility. There's multiple taxes, kind of like living in the US and in Europe. There's taxes for everything. There's a tax for time. The longer you want to hold that contract, the longer you're going to pay to have it available. If you want to buy real estate and someone says, hey, give me a week to come up with the money to buy it, it's going to be a small premium that you pay for that right to do that. If you say, don't sell the property for 6 months, you're going to pay a lot more money for that right. Time value is a tax. You're paying a fee for the right to do something. It's not built into the value. Oftentimes that value is not added into the purchase price when you pay for it. It's just an extra fee, an extra tax that you pay for time. And then we pay that extra tax for volatility. So knowing that there's always that extra tax, do you want to be a buyer or a seller? Typically, because that just adds more and more to the cost of an option contract. If it's in the middle, you typically still want to be a seller. And so if you're going to be a seller and you want to, the thing that you're really looking for then is trend, right? You want to know if you have that clear direction. If you know that the volatility is going to go up, or you have a high, you have a feeling that the volatility is going to continue up. And there are a few things you can do to know that, or to see that, or to have some additional clarity. One is that you can look at a stock or bond or option or future, whatever you're trading, and you can look and see that multiple directions, multiple things are expected to move big in that. And that tells you there may be some, and it may be moving down or moving up, but if they're going to be big moves, strong moves down, strong moves up in the projected future of those symbols, then there's a likelihood that volatility may increase as well. But the other thing is you can actually look at the VIX. You can look at the volatility, and you can look at the VIX on flow. So don't just look at the underlying symbol. Look at the VIX markets on flow and see where they're headed. So when the VIX is low and flow is saying the volatility is going to go up and the stock is going to go up, or the stock is going to go down, you know that not only is it going to go down, but it's going to start adding premium to it. If the VIX increases and it looks like the VIX is going to jump up, then you want to hedge on the side of being a buyer, because as it goes up, even if it doesn't go up much or it lags, the value of that option contract is actually going to increase simply because there's more price added to it because of the volatility, right? So start using multiple things. We always talk about time series stacking, using multiple times to see the 5-minute, the 15, the 30, the 5, the 60, the daily, whatever, that are all showing a bullish move or a bearish move to give us more confidence to be in that trade. You can now also use, instead of just time series stacking, you can add in volatility to the symbol that you're trading to give you the confidence to either buy something because volatility is increasing, or to sell volatility. So if it's in the middle and the VIX looks like on flow that over the next 3 weeks, it's going to, or the next week or two, it's going to drop off sharply, sell volatility, sell. So be a premium seller. So when it's in the middle, use flow to determine direction. Try to reduce the size of the thing here again. So use flow to help you figure that out. Let me see if I can tie that together. Okie doke. So that will give you that'll give you a big advantage. So there's a strategy, is using volatility as a way. Excuse me. That's a way to use volatility to help you determine what it is. Now let's talk about a second strategy. So I'm going to roll this down and I'm going to fill in. Excuse me. I'll actually do it this way. I'm going to insert another text box and we'll draw inside of that. Okay, the other side that I wanted to chat about, if you have if you are, let's see, how can I, what else I'm going to do? I'm going to add one more thing on here that I didn't really mention, but I want to share with you. If you really feel like something is going and you want to be a seller, you're selling premium, but you think the volatility is going to increase. So meaning that yours may move down a little bit, but you don't make any money on the contract, because as the intrinsic value grows, the volatility, which means that as the intrinsic value decreases, you sold it, you think you sold a call contract, meaning that you sold the right to buy it at this price, and the price drops. So you're making money, right? Because the further away it gets from there, the more money you're making. So the price starts to drop, but the volatility in the market increases. So the intrinsic value declines, which is what you want to see, because you sold it for 3 and now it really is worth 280. But volatility increases, it may stay the same because of what it's making in actual underlying value. You may not realize till the actual expiration. And so you're wanting it to move and move and move, and it's really not making a lot of money. It may not crash for a while, and it may end up bouncing around for days or weeks because volatility is increasing. And so now there's an extra premium added for Vega, and it offsets the money that you should be making because of intrinsic value, because of the actual underlying value going where you want it to go. So what do you do for that? Well, one is that if you're a buyer and you think at that time it's going to drop over the next few days, and it's going to rally, and it's going to drop, and it's going to rally, you may want to trade a shorter time frame then as well. And that's to make sure, hopefully I didn't lose everybody. And that's to make sure that that you're getting that quick move, the value changes, and you close out the trade. So that's one way, is to trade shorter. And the other is trade only strong directions. That means that you're not trading just because it's doing this over the next few weeks and you're selling it and you're buying it, and you're selling it and you're buying it. If you think the volatility is going to go up and you're trading and you're trying to make dollars and you're selling premium, and volatility increasing goes against you, you need to do it for a short term. So you're looking for one move, it goes down a little bit. And if volatility was even, you might make 50 cents. Now you're going to trade a shorter direction, and you're going to look and you're going to target smaller profit. So you'll hear me say, cash the check, right? It normally could move a bunch. You're going to target, as soon as it hits that target, get out of it, take your profit. So that's how you can kind of adjust to trading against volatility. If you still want to be a seller, but it may go against you, that's how you would modify it. So let's go down to this chart and tie it in. So the second, I'm going to give you another strategy. So those are kind of strategies on how to adjust which way you trade. But I'm going to give you 2 specific trading strategies. One of them you hear me share a lot. It's a vertical call spread. And the similar sister to that is a vertical put spread. And all that we mean by vertical, and I'm going to say, and selling is the same as shorting, right? If I'm selling that, and I'm going to use gold as a model for this because I just put this trade on today, and I didn't get the other ones off, but I have them offered out. So if you have gold, which is trades under the symbol GC, I think for the majors, if you're trading gold, and you think that gold is going to go down, you want to sell a call spread, right? You want to sell calls to hedge your risk. If you sell a call, what's the amount of risk that you have? You sell, it's at, let's say it's at 1900, and you want to sell a 1900 call. You're betting that from where it is over the next month, it's going to drop. You want to sell a call spread. how much money could you lose? You're selling the right to someone to buy it from you at 1900. So in a month, how far could gold move? Well, gold oftentimes, when it has big moves, especially down, but it does this going up as well, is not unusual for gold to have in a 2-day trading period a move of 8 to 12%. That's actually one of the most common breakout moves, and it happens several times a year. It either goes up or it goes down 8 to 12%. That's huge. If you have an options contract, which is giving you 1,000 shares for 10 cents on the dollar, if you had shares, you'd make 80% or 100%. Inverse that. If you sold an options contract, you could lose 80 or 100% in a matter of a couple of days. So how do you hedge that risk? You sell the 1900 contract, but then you buy the 1905. So now the most you can lose is 5 points, right? Because as soon as it gets past 5, you're long at 1905. And now everything after that is dollar for dollar. So the one you sold, he's making $1, but the one you bought, you're making $1. It's even. So you're limiting your risk to $5. So if you have a contract that's 100 shares or 10 contracts at 1,000 shares, then if it's 1,000 shares and it goes up $10, you lose $10,000, right? But if you're limited to 5, you can only lose $5,000. Now you're limiting your loss, but you also do what? You limit your gain because you're selling the 1900s, but you're turning around and taking part of the money you just sold. So if you sold it for, say, $2 for that contract times 1,000 shares, you made $2,000. You have 2,000 extra dollars sitting in your account. But if you sold, then you turn around and bought the other one and you paid $1.50 for that. You just spent 1,500 of the 2,000 you were making. So a lot of people don't like doing that because they go, gosh, I'm giving up, oftentimes 2/3, 3/4 of what I could have made. But you're also well defining your risk. That's really, really important because it's that every 4th or 5th trade that you really get smoked, even with flow, often early, rarely wrong. And it keeps trending. And if it keeps trending for an extra week past when you thought it was going to turn and it's going to close close by, you don't want to take where you made $1,000, made $2,000, made $1,000, made $5,000, and then you lose $10,000 or $15,000 because you're uncapped on the top. And you know what? The brokerage firms know that as well. So not only is it a good reason to manage your risk and have a very well-defined risk by using a vertical call spread, it also means that the margin is going to be substantially less because they know that your max loss is that. So what do? They make that your max margin because you can't lose more than that with that spread on. That gives you a lot more money to do what? To put on more trades. And it's a math game. It's a numbers game. You're not going to win on every trade. So if you win 2 out of 3, 3 out of 4, if you win 6 out of 10, you want to be able to have more trades over varying periods of time to start rolling in those checks. And every once in a while, you're gonna have to write a check. All the other times you're cashing checks, but you want to make sure that it's well defined. So at the worst case scenario, you may be writing a check for $5,000. There's ways that we can do that too. If we see it breaking out of resistance levels and it goes up, we don't have to wait till we're fully losing everything that we put in. We can see it go up. It may retrace a little bit. We get out of it. We lose whatever it is, $500, $1,000, but we don't have to lose 5,000, right? But that gives us a hedge. It also makes it so that you can sleep at night. If you're worried that something's going to happen tonight or over the weekend, look at the news any given day. You don't know if a country's going to be invaded. You don't know if a president's going to change, if a law is going to be implemented. You just don't know. If you want to sleep well at night, use spreads, right? That may be the message for today. If you want to sleep well at night, use spreads. So if gold, I think, is going down, it's 1900. I'm going to sell. And this is middle of February when we're doing this. So I may sell a middle of March, 19, instead of, I can sell at 1900. And if I sell March 1900 and buy a March 1905, it may cost, or it may bring in a positive. And then the option contract may be, let's see, 50 cents. and you multiply all that, that's per share. So if it's times 100, that's $500, right? So if it brings in, or $50, excuse me. So it brings in $50, right? And if you do 1,000, and so you sold, what happens is you sold the March 1900, and you can do this actually as a spread. So most systems, you can say, I'm selling a vertical 1900, 1905, and it's going to tell you the price. You can sell it for 20, you can buy it for 50, and you can go work it out and offer it for 40 and see if somebody will hit you there in the middle. The more you watch it and you see where it prints, you'll know, should I be selling it closer to 20 or closer to 50? Typically, I try to sell option contracts that are at least 40% of value. So if my spread is $5, when I sell that contract, I really want to make at least $2, because my risk is the other side. If I sell it for $2 and it goes against me, all the way against me, I could lose $3, right? It's the difference between what I made in premium and from one side where I sold it and the other side where I bought it. That's my risk, is that space in the middle. If that's $5, 1900 to 1905, 5 points, $5, and I sold mine for $2, that means I'm risking $3 to make $2. The difference is, in most of these spreads, especially when you have tools like flow, you'll find that you have a high profitability ratio and a high probability ratio, especially when it's managed properly. So you are risking sometimes more. Are there times that you can sell for 250 or 3 or 350? Absolutely. You'll see me selling contracts at 350, 365, 380, and it may be in the money. I may be actually selling, but I think it's going to drop off from right there. The bottom line, though, is that 380 may be high volatility, maybe whatever. But if I sell it for 380, I only have $1.20 risk. I only have $1,200 risk on my 10 contracts, and a potential of making $3,800. So those are really great. But oftentimes in markets where they're moving and you're selling a spread that's outside the market, OTM, you'll see the acronym OTM versus ITM, which is in the market. I'm selling something that's already past that price, and I'm hoping it's going to drop back through it. I prefer out of the money. If you're conservative, you should sell out of the money. As you become more aggressive and you're trading bigger stocks, things like Tesla and whatever, that are large price and they move hundreds of dollars in a day, oftentimes you can sell in the money and you can bring in more premium for that. And of course, that premium is still capped typically, because there's only so much that you're going to make as well. So if I sell a 1900 and I buy a 1905, the value of a 1900 strike price is higher than a 1905, right? Because it's a call contract. So the higher it goes up, the lower the premium is. So I'm selling the higher premium and I'm buying the lower premium. And so I net the spread. So if that brings in 50 cents, you're doing what? You're looking for that to, put a bullet point here. You're looking for GC to drop in value by the March expiration. And for those folks in Europe, we'll call it the March expiry, right? And if you watch it and you trade it regularly, you will get to appreciate, or you have a software platform. You can interpolate, you can extrapolate, you can figure out just from looking at it oftentimes what portion of the 50 cents is theta, time value, right? What part is vega, which is volatility. And so for the purposes of the talk today, we want to look at volatility. And so you can actually watch that premium for volatility go up and down, even if it's doing that over the course of the day and you think it's hitting a top, it's staying in a range, hitting a top, and it goes from 25 cents to 35 cents. You may want to put your price out based on the 35-cent volatility, so you're bringing in more premium and waiting for that to get up where somebody's getting scared, they're buying it, what you're selling, and they're paying a little extra to hedge themselves or whatever the case may be, and you're pulling in extra premium. If you're selling something it's 1900 by 1905 and it's trading like today at 1899 and a half, there is no intrinsic value. right? You're selling a contract that has no value right now, and you're buying one that has even less value in the future. So this is all theoretical, and you're using tools like flow and price action, and you always use your price chart to see where resistance levels are and where support levels are, right? So you're watching where that is. So you're literally taking in 50 cents that has no value in the market. So you're selling insurance. You're selling insurance to somebody who's concerned or worried that gold is going to go up, or they think that it's going to go up and they want to profit from that. They're buying it and they think that it's going to break through and have some sort of benefit. For us, we like to sell when we think there's time, and especially multiple moons in alignment on flow suggest that this is going to drop. Is flow always right? 82% of that data falls inside of those blue lines. Mathematically, it's at least that over time. That means that 18% of the time it doesn't, right? So you can go, wow, this is a high likelihood that I'm going to make money. 18 to 20% of the time, it's not, right? So we need to be cognizant of the fact that it's not always, that it doesn't necessarily mean that it's always going to be the way that we want. So that being said, we want to make sure that we are trading in a way that if we're wrong, we can afford it and we're okay with it. It doesn't blow out our account. And more importantly, it actually is not a large enough or more important trade. You bet the house, you back up the truck, you borrow from friends, you mortgage the home. You should never do that for a single trade, because there's going to be another one next week. Just do it again and again and again. It's all about stacking up dollars and putting some aside, stacking up dollars and putting some aside, right? That's what a good trader is. Will you have a big day every once in a while? You will be rewarded more than you expect to be rewarded 3 or 4 or 5 times a year for being there, for showing up, for being steady. And every once in a while, you're going to have an opportunity and you're going to really, really get paid. It may happen most often in the second strategy, but I don't want you to get in the habit of doing that all the time. You need to be trading regularly to see when those kinds of opportunities happen. And one of the reasons that I was interested to share this message today, this week, in this period of time, is that we've got volatility starting to change and turn up, which means there's an opportunity to use this second strategy when we see the volatility may be increasing and we see things that have really been beaten up and that may turn around. It's an opportunity to use this second strategy. And that second strategy, we alluded to it earlier, is to buy out of the money options. This is naturally an aggressive trade. How aggressive it is dependent on how out of the money you go. Use the bullet points again. Because again, it's the inverse of what we just talked about. When you buy out of the money, so gold is trading at 1900, you think it's going to go to 3000, and you buy a 1950 call contract, how much of what you paid is intrinsic value, is actually in the underlying value? None, right? If it expired today, it would be worth 0. Everything is based on volatility and theta and a little bit for the other Greeks. That is important to know. So you're literally buying a ticket, like a lottery, where you think you have a 4 out of 5 chance of winning. That is literally about the math. If you are right and you have multiple moons in alignment with flow, you have about a 4 out of 5 chance of winning. It means you also have a 1 out of 5 chance of losing. So when you make money, you make 50 cents. And when you lose $1.50. You better make sure that your math is right so you don't wipe out your earnings from that one bad trade. It also means that when you're losing, the great thing with options is it's not like a lottery ticket where you either win or you lose. Your numbers are either correct or they ain't. That's not the case with options. If you see it breaking through support, you can either say, well, it's going to drop one more level. I'm going to buy more options. I'll average in a lower price. That's one thing to do. Averaging in for staggering gains is a professional tool and technique, not something that a level 1 trader should be doing, something that really a level 2 trader should be doing. It's level 2 should be buying in when it goes up, sets a higher low, and you buy more, sell some, sets a higher low, you buy some more. That's when you do level 2. Level 3 is when it drops and it comes down precipitously as a dead cat bounce, comes down, and you wait for it to go the next level down, and you buy 2 more lots instead of the one that you had, or 3 more lots. And then it bounces up and you sell one to get back light. It drops down again and you buy 3 more. That, and you're waiting on that sharp turn, because when it turns, it's going to rock and roll. That's the way a floor trader would do it. Those are people that don't use stops, or people that take big moves down, and every once in a while they get whacked, but they also are there for huge moves up. You should not be trading that way unless you're level 3 or better. And we were not going to get into the different levels today, but that is something that's very, very aggressive. But can you buy out of the money options and make money if you are a level 2 trader or above? I think brand new traders should stay away from this tool. You should be in the habit of using spreads where you have a very well-defined risk and a high probability of winning. You have a limited potential of what you're going to make, $800, $80, $200, whatever it is, but you're not going to make $40,000 on that trade, because it's going to be very well defined if you're a level 1 trader. If you're a level 3 trader and you're moving into new things, or you're level 2 and you want to try something with a small amount of money, an out of the money option may be something to consider, especially. And so we're talking about this when it's better when vol is low and increasing, right? So if volatility is increasing and you're not exactly right, you buy that contract. Remember, we said that even if it doesn't go a lot, if other things in the market start to go and it lags and it just doesn't go, have you ever had that happen? Google's running and so-and-so's running and whatever, but your tech stock isn't really going anywhere. What's going on, right? That does happen. So it really benefits if the VIX is going up, if the volatility index, especially for the sector you're trading, is increasing. Typically, if you're in the same or similar sector, they're typically about 80% correlated. So there's a 4 out of 5 and 80% likelihood that whatever you hold is going to go up anyway, because it's riding along with the sector. If it's a pharmaceutical company and somebody else got approved for a vaccine and this company doesn't even have vaccines, oftentimes those pharma companies will still go up in value because they're part of the sector. People are buying the pharma ETFs, they're buying whatever it is, they may go up, but it may not go up like you thought it was. But the volatility of the whole index is increasing and you may make a little bit of money. So that is a hedge on your behalf as a buyer, is when volatility is going up. So this is a strategy to use when volatility is low, but it's expected to increase. How aggressive you are is based on the size of contracts and the strike price, closer or further, right? So if you think gold is going to go to 3,000 and you think it's going to do it over the next month, if you buy a contract that's 2 months out to make sure that you give it enough room, the further out you go, the more you're going to pay in time value for that opportunity typically, right? So you're going to pay a little bit further out. If you come in closer, is there more risk or less risk? The further you come in, you think it's going to reach that goal in 30 days. So you buy a contract for 30 days. That's actually higher risk, right? And the reason you're taking more risk is so that you pay less premium. You're paying less premium because the person selling it to you has less time that they have to make that available, and less risk that the market's going to change more, right? So as you move closer to what you think is the time, the more risky that trade is. The riskier the trade is, the better a trader you better be, or the more money you may need to have available to lose if you're wrong in that space. So the strike price in time is one of them. And so let me see, and that's actually the strike. That's actually time to expiry, right? So let me put it in numbers so that we can talk about each one separately. So we were talking about the last one and time to expiry, right? So if you get a strike and you have a time to expiry on your strike, so you have a March 20 call, the time is March 20, however many days that is, 30 days. The strike is you're buying a March 20 strike The 20 is the price, right? And it may be a March 20 date, March 2020, strike at $20. So whatever that strike price is also closer versus further, right? So, and let me add this in for the earlier one, just so we can keep them in parity. So we talked about time expiry. And let's spell further correctly. And so now we're talking about strike. So in the strike price versus the strike expiry date, in the strike price, if you think it's at 1900 now and you think it's going to go to 3000, if you buy a 2000, that's still way away from where it is, right? That's like almost a 50% jump from where it is right now. That's going to cost a lot less. So if it gets close to that and you paid 5 cents for that, there's a chance it could go to $5, right? It could just kill it, but you're going to pay not so much. But if you buy a 1950 strike, you may pay $1.50 or $2. You may pay 5 or 10 times that price. So you spend a lot more money up front, but there's also an exponentially higher likelihood that that number is going to get hit. So the closer you are, the higher the price you pay, but the less risk you take. The higher the price you pay, the less risk you take, right? If you buy food in a developing market at a well-established restaurant, you pay more for that food. You have a lot lower risk of Listeria and E. coli, but you pay more for that food. If you go out on the street and you buy similar food that's a little bit less, but may fill you up, and you pay a third of the price, but you have a higher risk of those other things, right? So that's the way it is with the strike number. So more aggressive traders so there's two ways to adjust for that. More aggressive traders may buy further out and buy more contracts. They may say, look, I got $5,000 to risk. I'm going to buy 100 contracts of this. And that is the times where you'll see guys having 7-figure days. It busts through it and they get paid, and you see them with the Ferrari and the Lamborghini, and then you don't see them 3 months later because they did that a few more times because they thought they were geniuses and they lost everything because it didn't quite hit that number and it came to expiry, or it just wore out, right? That time value decayed, that decay of theta, that decay of vega just kind of sucked it away, and eventually it ran to a place where they had to sell it and they lost a bunch of money. So the further out it is, the bigger the risk that you're taking. So there's a couple of ways to manage that. And the first one is number one, which is size of contracts. So let me put a space here too. So one is that if you say, look, I don't have a lot of money, this is a flyer, I don't want to do a lot, well, then go buy that 5-cent one that's at 50% more. And interestingly, it doesn't have to go all the way, but if that contract is 2 months out and then 2 weeks later it goes up to from 1900 and you bought a 2000 and it goes to 19,200, 19,300, and it's still way away, but it's gone up 200 or 300. That nickel may now be 10 or 12 cents, and you doubled or tripled your money. But if it's really not taking off, you may still be able to make money on that exponentially more, right? You put in $100 and you made 200. You put in 500, you made an extra 1,000. So you can make dollars on that without it actually having to go to that price. But remember, once it gets inside of that 30-day period and that theta starts decaying, and if volatility is going down, volatility is going to decay. It's going to go down quicker. But if you're in a low volatility, a low vega, right? This area we talked about here, that's a hedge for a further out of the money. So for people like me, and I see some things that look like they may rocket, I'll buy 2 or 3 or 4 that are several strikes out of the money. But the way that I manage it is I don't buy as much. Instead of buying 100 contracts, I'll buy 10. You could buy 1, right? You buy fewer contracts, buy a few of this, few of that, and literally it may not move much, but I may make money. And so because the volatility increases. So if I'm buying into that, I'm looking for things that are weak, but are going to gain in strength or may benefit for increased volatility. When that happens, I can really, really get paid. If I'm also right on price, I go from making 100 or 200% to making 1,000%. That's the difference. But you have to wait. And that means you can't do it every week. It means sometimes you're only going to do these kinds of trades 2 or 3 or 4 times a year. We're coming into one of those places now. That's the reason that I wanted to share the story with you today. Adjust the size of the contracts if you take this model. You really should not be doing this unless you're at least a level 2 and preferably a level 3 trader. If you are a level 2 trader and you're wanting to do it, either put very little money at risk or trade very small number of contracts. Trade one contract at a time, two contracts at a time, and give yourself room. Instead of trying to get as many contracts as you can that expire in a week, double the amount of time. You think it's going to take 3 weeks for this to happen, or 3 days. It takes 3 days. Buy a contract that doesn't expire for 2 weeks, right? If you think it's going to happen in the next 2 to 3 weeks, buy one that doesn't expire for 6 weeks. Give yourself plenty of time for this to happen. And then take that amount of money and assume you're going to lose 50% of it or all of it. If it's way out of the money, assume you're going to lose all of it. And whatever you can afford to lose to put on that, then buy those contracts. I would also recommend that you find 2 or 3 symbols to do, and you build into those over, typically volatility stays low for a period of time, days or weeks, before it really pops. So most of these trades that you're going to do with this buying out of the money option strategy are going to be trades that are 3 weeks to 3 months. Sometimes they're 6 or 9 months. One of the great traders on our platform called soy earlier in the year, a few months ago, and it literally has gone up 18x since he talked about those out of the money options. That happens about 2 or 3 times a year in the stuff that he trades. But if you can make 18x, you don't have to have that many. So in addition to the other things you do, this isn't meant to be something you do every day, trading way out of the money options. The people that do that on a regular basis all the time, they come and they go, they disappear. Those guys are not around for 5 or 10 years. The ones you see on TikTok and Instagram that say, hey, I made this, do it, am I using OTM strategy? You can't use an OTM strategy all the time. There's just times where it goes for weeks where it's just really not a prudent thing to do. All volatility in the market is too high, and you're paying too much for that ticket, for that opportunity in OTM, for out of the money stuff. So there's periods when volatility is high, you should not be buying out of the money options. So this is a strategy that may be good now, and there may be another 2 or 3 times in the year where volatility drops down this year, and it'll be and it's a good time to have this strategy at hand. So we know where to look on the VIX, whether it's the CBOE or you're looking at the S&P or what have you. These 2 strategies, selling vertical spreads, and that may be a vertical put spread. You're expecting things to drop, but you want to hedge yourself, or call spreads, you're thinking things to go up, but you're going to hedge yourself. Call spreads and put spreads are great ways to do it. Vertical spreads are one of the simplest, easiest ways to get started in that. Buying out of the money options for those times where you feel like you want to take a chance on something, you want to gamble a little bit, treat it as if you're gambling. Treat it as if you're going to lose that 100 or that 500 or that $1,000. And if you have an account worth $10,000, how much money should you put on OTM options? Not much. The answer is not much, right? It should be, if you have a $10,000 account altogether, you should be betting over $1,000. That's 10% of your portfolio. If you lose that over the next 3 weeks, how are you going to feel? How's your psychology going to be next month? How's your account going to be? You're going to have to go and chop it back, making $200, $300, $500 to build back up. So when you do that, my recommendation is you find 2 or 3 symbols you can do it with, and you put very little at risk. You know, one contract. And once you have a little built up, that can be your risk pool for doing it again. That's my recommendation. Those are 2 great strategies. I literally have been using both of those for more than 30 years. If you use them right, you're prudent about them, they can make you a lot of money over time, but you need to know when to use them and how to use them. And you'll have a definitive advantage in the marketplace if you combine that and you use a tool like Flow to identify when those markets are going to go up and when that volatility is going to change. So hopefully this has been of value. I know a lot of you are options traders, but more of folks are stock and futures and crypto traders. Hopefully this brings a little bit of extra value, another arrow in your quiver. And if you have questions, jump on the Discord channel, send an email to tradeoracle@protonmail.com. Join us and open up those questions. That's what we're here for. Thanks so much. God bless you. Have a great day.